Tertia Jacobs is a Treasury economist at Investec Tertia. Good evening to you. Thanks for your time. So the Reserve Bank there talking about the fact that this interest rate increase is, of course, in line with market expectations, and certainly many economists got the sense that the bank would go in this direction. However, South Africans who are really feeling it the most, not happy at all.
Yes, Gugu, the market or many analysts expected the 75 basis points. There were some expecting a 50 basis points, and as the governor indicated, of the 5 MPC members, 3 were in favor of the 75 and 2 members were in favor of the 50 basis points. So I think the issue here is that we are moving towards the relatively difficult to say when, but to the top end of the rate hiking cycle. And I think going forward, if there's more rate hikes to come, the 75 basis point will not be repeated.
Of course, while it might be in line with market expectations, Tertia, and really being back at pre-pandemic levels, the state of economy, the economic state of many South Africans is not back to pre-pandemic levels.
No, Kathy. I think, this inflation that we experience is to a large extent cost push driven. The load shedding is weighing on the potential growth rate of the economy. In other words, the amount of goods that and services provided in this type of economy is actually declining, as the potential growth output has now slipped to about 0.7, 0.8%. The Reserve Bank's concern is that, that demand remains above this type of potential output. So in other words, the demand exceeds the amount of goods that are produced within the economy, which will continue to exert upward pressure on prices. So I think where they're then coming from is they're watching core inflation, which accelerated to 5% in September. And they're worried that it's getting broader based. So this is where, we're watching, where is the rand going? Where is public sector wages going? Because the governor also flagged that in this kind of environment, Transnet wants higher freight costs. Eskom requires higher tariff increases. Municipalities are looking for higher rates and tariffs. So they're trying to arrest this spiraling of price increases. And unfortunately, to convey the message, you have to adopt a very tough stance. So I think then, to your point, the consumers are facing a lot of pressure on their finances. So hopefully, inflation is turning the quarter roundabout in the second quarter, and that would then allow interest rates to move sideways. So I think we're in for a few tough months, but hopefully things could start to improve somewhat from the second, the third quarter.
There was always an expectation, Tertia, that coming out of the pandemic, interest levels would increase again. Has that increase taken place at a much more rapid rate than you think was initially anticipated?
Yes, because, when the Reserve Bank embarked on the so-called normalization of policy rates November last year, so it's now a year ago, the view was that it was going to be at a measured pace, and it could probably take 2 to 3 years getting there, right? So the rate hikes that we've seen starting from 3.5% to 7% has taken place in the span of, make it 15 months now, okay? No, not 15 months, 12 months.
Yeah.
So it was aggressively front-loaded, and the catalysts were obviously, the Russian invasion in Ukraine, the American inflation rate that surprised to the upside, the energy crisis in America, the acceleration in global food prices, and then the sharp depreciation of the rand as the dollar strengthened. So this unfortunately forced the Reserve Bank to show its hand much, much earlier.
what does this mean then going into the future? Because, Tertia, many of the people that would have made financial decisions, including taking on more debt over the last 2 years, would have done it within, yes, a reasonable expectation, again, of these increases going up. The rapid rate at which they've gone up, I think, is something that many would not be prepared for, because collectively it, of course, then weighs on the budgets of many households.
Absolutely, Kathy. And when you look at many of the central banks, the foreign central banks, right, from the ECB to the Bank of the UK, the FOMC, we've got their minutes for the October meeting last night. There's definitely a focus on now beginning to monitor the lagged impact of this aggressive front-loading. In other words, many of the central banks hiked rates very quickly. So because there's a lagged impact between interest rates on the real economy and how it impacts inflation, many of the central banks are now going to start slowing the rate of increases. So because we're not 100% sure where inflation is heading next year, it should come down, but how quickly will it return to the target? There could be more rate hikes, but there's definitely a slowdown in the pace of rate hikes. So I think from next year around the world, we are going to move in this slower, measured type of rate hikes.
What do you think South Africans should brace themselves for over the next couple of months? Because, already now, we're, of course, looking into what would be the first quarter of 2023 and expectations of what people should bear in mind.
So my view is we may be in for another 25, maximum 50 basis point rate hike, and then rates will start moving sideways. So I do think we are very close to that hiking cycle, because inflation could start to moderate from about March going forward. So if that type of scenario plays out, I do think the Reserve Bank has done enough, and they could also reach the point where they can monitor developments.
All right, Tertia Jacobs, let's leave it there for tonight. Treasury economist with Investec. Thanks for your time.